Have you ever wondered how you could invest directly in the very engine of a country's economy? Well, today we're going to dive deep into a tool that's designed to do just that for India's financial giants, the Aditya Birla Sun Life BSE Top 10 Banks ETF. That's a really big question, right? If you're bullish on a country's growth story, one of the most direct ways to get in on the action is to invest in the sector that's literally fueling all that growth. And in India, there's no doubt that engine is the banking sector. And just how big is this engine we're talking about? Get this. Banks hold roughly 66% of the total assets in India's entire financial system. They aren't just a part of the core, they are the core.
All right, so let's get into it. What exactly makes India's banking sector such a potential powerhouse for investors? Why does it matter so much?
Well, for starters, the scale is just massive. We are talking about the fifth largest financial services sector on the entire planet. And look at the growth. In the decade leading up to 2025, key things like deposits, credit, and earnings, they didn't just grow, they tripled. The sector wrapped up the last calendar year with its healthiest balance sheet in more than a decade, all thanks to really stable assets and solid capital reserves.
And the story here is all about demand. This isn't just theory. You can see it happening. This consistent climb in credit growth, from 7% all the way up to 19%, it shows a booming economy. Businesses and people are hungry for loans, and that's a fantastic sign of economic muscle.
And it's not just about lending money out, right? On the other side of the equation, you've got this steady growth in deposits. Now, this is absolutely crucial because it signals public trust. Plus, it gives the banks that stable, low-cost cash they need to keep lending and growing. You need both sides to be strong, and the data shows India has them.
Okay, so the sector is clearly strong. But how do you, as an investor, get a piece of that action? And not just any piece, but a focused piece on the biggest players. Well, that's where an ETF like this comes in.
Yeah, think of it this way. This isn't some broad, scattergun approach to the market. This is a precision tool. It's like a dart, aimed squarely at the bullseye. India's top 10 banking leaders.
So what is this thing exactly? Well, it's an exchange-traded fund, or ETF. The easiest way to think about it is like a single stock you can buy and sell, but inside that one stock is a whole basket of companies. In this case, the top 10 banks, all tracking a specific index. Now, this is super important to understand. The objective here is what we call passive. The fund isn't trying to be clever and beat the market. Its whole job is just to mirror the performance of the BSE Top 10 Banks Index as closely as possible, minus some tiny fees.
All right, to really get what this ETF is all about, we gotta pop the hood and look at the index it's built on. What's the actual blueprint here?
The beauty's in its simplicity. The rules are totally straightforward. There's no manager picking stocks based on a hunch. The index simply takes the 10 biggest banks, both private and public, from the huge BSE 500 index, and it picks them based on one thing: their market size.
Whoa. Okay, now this is where you really see what this fund is all about. The concentration is pretty striking. Just look. HDFC and ICICI Bank together make up more than half the entire index. This is not a fund of equals. It's a bet that is heavily weighted towards the biggest of the big. And that concentration, that's where both its potential power and its risk come from.
And this whole thing isn't just a set it and forget it deal. It's a dynamic system. Twice a year, every June and December, the index gets rebalanced. It re-ranks all the banks by size and adjusts the holdings to make sure it's always tracking the current top 10. It keeps the ETF right in line with the market leaders.
Okay, so we've seen the shiny side, the potential. But as we all know, investing is a two-sided coin. So let's get real and do a reality check. Let's talk performance, resilience, and, the risks you need to watch out for.
Historically, this sector has proven to be a real fighter. As the source material points out, banking indexes tend to hang in there better when the economy gets rocky, and then they bounce back stronger and faster than the broader market during the recovery. They're definitely cyclical, but they're resilient.
And that's not just talk, we're seeing it in the numbers. In the last calendar year alone, the index this ETF follows delivered returns of around 18%. That made it one of the absolute top performers in the market, really cementing that reputation for strength.
But, and this is a huge but, that powerful performance potential doesn't come for free. The official risk classification for this ETF is, and I quote, very high.
So why very high? Well, it's pretty simple, really. You've got all your eggs in one very specific basket. You're completely exposed to anything that affects the banking sector, regulatory changes from the RBI, a sudden shift in interest rates, the risk of bad loans piling up, and of course, growing competition from all the new fintech companies. This is the opposite of diversification. It is a highly concentrated bet.
So all of this brings us to the most important question, right? Given the high-risk, high-reward nature of this ETF, who should actually be considering it? Is this thing right for you?
Let's be crystal clear on this one. This is not a core holding for every portfolio. You should think of this as more of a satellite investment. It's really designed for an investor who already has a solid, diversified core, but wants to make a specific tactical bet on the long-term growth of India's banking system.
Let's just compare them side by side. A broad market ETF, that's your core. It gives you diversified, economy-wide exposure. This banking ETF, it's the opposite. It's concentrated, it's sector-specific, and it's built for a tactical play. It's about adding a high-octane component to your portfolio, not building the entire engine with it.
And just a quick technical point here, especially for any of the pros watching, it's good to know how an ETF like this stays liquid. While most of us will just buy and sell shares on the stock exchange, the big institutions can actually go directly to the fund house to create or redeem huge blocks of units. It's that mechanism that helps keep trading smooth for everyone.
So, we've come full circle. This ETF offers a really powerful, really focused way to invest in the engine of the Indian economy. The potential is obviously there, but so is the risk. So the ultimate question you have to ask yourself is this: is making a concentrated bet on India's financial future the right move for your portfolio?